Hi, Praveen. Thank you so much for coming to the Investor Talk. How's it going?
Thank you, Massimiliano. It's been a great start for the year. So I'm looking at a positive curve for this year. So thank you for inviting me here.
So, first of all, let me ask you to give it to our audience a short introduction of who you are, where you're coming from.
Sure. Well, I'm Praveen Mayakar. I am originally from India. Bangalore is the city. It's the IT city of India, also called the Silicon City of India. But I've been in Sweden for the last 17, 18 years. So I ended up moving here for work and studies, and then ended up getting stuck. With the world between India and Sweden, I've been doing a lot of things. I'm a technologist from the ground up. I've been in different companies, small, medium, and large, working with different parts of the full stack. Lucky to have had touched all these frontiers, all the way from IC design all the way to the web technologies that we have had. I've also taken time to work with some of my ideas. Some of them I call them small businesses, some of them startups. I've assisted with other startups, being a co-founder, advisor, sometimes board member. A lot of the times I end up seeing myself as a systems thinker who is into venture building with a flair towards product and technology. So my day-to-day job is mostly thinking about products, and once you get into that world, you start seeing products everywhere and how each product is bringing value to our life. So as you see my tagline here, so what I want to bring focus more than identity or vanity is to really nurture value and growth to humanity itself. So my simple effort here is to help people build businesses that make a positive impact. And a lot of us need help, and this is where I feel we should work closely in a collaborative sense. And startups, as you said, are many, and they also fail. But that's the best world where you can try out these ideas. And I give kudos to every founder, because they could as well get a 9 to 5 job and just come back home, see Netflix, and sleep. But they take that extra energy and passion and do that, and it requires courage. And for that reason, I like to be in this field.
Thank you. Thank you so much for this introduction. Um, Let me follow up on one topic that you just mentioned. Uh, Especially in pre-seed stage. I mean, what is my experience? I've been working in startups since 2014. I do my angel investment sometimes, and I do a lot. I've done 6 startups. EquityMatch is my 6th one. So I like to call myself an entrepreneur, but as you said, you as well, you are very close to being an entrepreneur. In any venture studio, for example, it's a kind of entrepreneurship. But my question is, how do you see the role of an investor at a very early stage? Because many angel, they sign the 20, 50 ticket, 50K ticket, and they stop there, okay? That's fine. I mean, if you invest in a startup fund, that means you believe in them. You don't need to be, they manage their day-to-day activity, of course not. But do you see at the very early stage, maybe this can be one of the reasons why startups fail in 12, 24 months, because that's the average failing of startups, because they can't scale. Do you see an investor be more proactive, not running the business, of course not, but supporting the founders in taking which are the key decisions to be made, making sure that you are not running a model that doesn't make any sense, you are not charging your customers 10 times what you should, or you are not charging at all. So as I try to understand, as I try to tell to our founders, you need to understand if people are willing to pay your business or not, your product or not, your service or not. Otherwise, you'll be running forever for free, and not everyone is called WhatsApp, and maybe you will die. So, where do you see the role of investors in this perspective?
Oh, very good question. I think angel investor, as the name itself suggests, is one of those words very aptly used and well thought out. And I like the phrasing there. And as the word says, it's an angel, right? So angel, because if you see a founder or a startup as the egg that has not hatched yet, it has a potential. This egg could be a duck, it could be a dragon. You don't know its potential. And at that point of time, somebody has to nurture it. It is not realized what it is. It is to be nurtured to grow into a certain stage, get its wings, and then to fly. In the technical terms, I would call that as bootstrapping, building, shipping products, and then validating it into the market, and then scaling. When you scale good enough, then you have started to fly. An angel, for the word itself, is one who is coming in to nurture the founder's idea, the vision, or look at the product from a market perspective and then see why is this really needed, what is the pain point it's solving, and how can I nurture this problem to be solved with this idea and with this team. Typically it's one person or two people in the beginning, and they are the ones who are taking the bet. uh, Typically what happens is the angels are not in the uh, right industry or right sector, or don't have that system thinking, and they end up looking at it from a pure objective point of view, or because there's a speculation or a trend. So
Yes.
in the early stages, it's super important to give lot more care to what we are building. Of course you can pivot and all that, but there are some ground rules that you need to have, and those cannot break, because then you break the egg. In this case, you break the startup. So that part is something I observe, and that becomes the devil part. So you don't want to be the devil, you want to be the angel. And
Yeah.
the second part is you're an investor also, so which means that you're putting your time, your thinking, and you're contributing with finance. And your responsibility there is also to assess the value. Of course, you would want a reward for the promise that is made today, but at a later stage. So it becomes a bit of a responsibility to lead and then make sure that this egg hatches, and then you provide the right guidance. Not every angel gets that chance when you see the market today. So this is what the ideal world looks like to me, and then there's speculation and the market trends and people going in because someone else went in. So the investor part is also needs to be understood better from a founder's perspective, because it's not just an angel, it's also an investor. You need to understand that you need to bring back this value to them. So you should not just go ahead with whatever you think is appropriate. So there are no rights and wrongs in the beginning until you figure it out. So my best bet is to bring the value to the product or the problem, understand the nature of the problem first, understand what your solution is, because there are multiple ways to address a solution, and then how is it de-risked to begin with. The first 24 months, it's all about de-risking and a lot of learning, talking to customers, potential pilot programs, and then bringing that uh, bringing that speed of know-how and leverage that you can create for the problem, and then solve it. Even if it's not 100% solved, not with 100% accuracy, you're able to bring some value to them. And when you bring the value to the customer, then you have given the problem statement a solution, answer, and then you start adding value to the company. That will bring value to the investor. Sometimes it has become during fundraising that it's very easy to start going out and start asking for money, but remember that this is borrowed money, and real value is in the customer. If the customer goes away, you don't exist, your product doesn't make sense, your investors are not going to be happy and they lose money. Of course they are playing a bet here, so that's why they diversify. But it's super important for the founder, because they get this one chance to make this to come to reality, and they put a lot more effort than the investor. So So the angels need to provide those wheels. When you're learning bicycle, you have these extra wheels. So that's what also needs to come as guidance. So I believe this is how I operate, and this is where the nurture part comes. The value part comes as you start guiding and cutting off what not to do. That's strategy. Making the choice, making the decisions with what you best know, and then going further from there.
Thank you. I mean, this is very. I really agree. What I noticed when I talk to founders is, I mean, when it comes to, let's be more focused on angel investments where we are now, is they the lack of absolute capacity of managing cash. Uh, for example, you're raising 250K, which more or less the average of pre-seed funding in Europe, where we are. And you stated you run away for 12 months, 24 months. But the reality is when you launch a company, especially when when you build your product, that's fine. You are not spending money for marketing. More or less, you are paid 2, 3 people. Maybe the founders, they have already scheduled expenses, right, for the next 12 months. But when you start scaling, it's so difficult. It's so extraordinarily complicated to really understand how much you're going to spend, because maybe you need marketing, maybe you need many other things that you didn't even think about. So, do you think one of the reasons why startup fail at such a very early stage, not when are only two founders sitting home and coding, but when they need to go to market, because they estimate 100 and they need 500. And when you are 2 months short to run out of money, it's too late, because maybe people, they don't give you the money. Because what I try to tell to the founders is, if you're coming to me 2 months before running out of money, it's very risky. It don't make me comfortable at all. Unless I am an unexperienced angel and I won't even understand what that means, but I won't give you 50K if I know that 50K will only give you another 2 months of briefing and after you will die. It's not good for you, it's not good for me. So do you think angels at the very beginning should really help funders, should really be mentors as well, and not just giving them money and that's all? Because there are too many things, that especially founders in tech, where the majority are engineer, or yeah, the majority of them are engineer. Today with AI, I mean, it's maybe less complicated somehow. But do you think angels must be mentors, advice as well at the same time, and not just giving money and waiting for result that sometimes never comes most of the time?
Yeah, I think, I personally, if you ask me, I would like that to be a mentor, especially on the ideas that I believe have a problem statement out in the market. And when I said guidance, I meant, being a mentor there. And of course, depending on what you raise and what's the ticket size and all that, you cannot just get so many mentors. So you need probably a strong mentor with an experienced angel capacity, uh, who can guide you. And I think the best example that I've seen is Mike Markula, who helped Steve Jobs and Wozniak very early in their journey in Apple. He pretty much looked into the whole case and made a business case out of it, and then said, "Okay, I see a bet here," and I put 200K. And then he was there with them for quite a long time. And that kind of hand holding, guidance, and like keeping together is super important. And also, founders, they start with some skill, right? And they start with an assumption. It could be engineering, or it could be design, it could be also some level of product thinking. But they're also one dimension when it comes to those skills. And when they become the bottleneck in that skill, they need to start realizing, I need to add on more people for the other streams, or I need to elevate myself and then replace myself in this role. And that is not very easily seen, and they do a lot of assumptions in the beginning. And it's okay to start the journey, but for you to grow with the journey, you need to start questioning what of which of my assumptions have actually started to fail. How do I, change those? It doesn't have to be a big change. Like it's like navigating a boat, right? You press the gas on it, and the result comes a little slower than on a car.
Yeah.
And if it's a wind, then it starts moving. So you need to do these tiny adjustments, but be aware where the wind is, how it's going, and which direction you're taking, and that's super important. And that's where the mentoring and guidance is required. For me, it's three major stages of any business development, and that's product engineering, or technology of any sort, and then the design part. These three need to be there, and a strong business acumen sense. And if you don't have this in the beginning, and you think, okay, I'm a CEO of the company, I'm going to develop this, you're not going to develop this overnight. Few people have managed to do it, and I'm sure they've gotten help. It's just that the stories are not out there. It comes out when you ask them. But getting that support is super important. And I feel, especially founders, being smart learners and executors, they need to uh, become smarter by working with other smart people. So you need to get your collective together, and this is the only way you can de-risk. And what I've seen as an angel investor is that I do not get that chance to be influencing. I've seen many times that, okay, this is not going in this direction. I do send some signals, but if you're not in there, right next to the driver's seat where the entrepreneur is driving with their engine, and you want to say, you might want to take left or right or slow down or put the brakes. And if you're not in the in the vehicle, you don't have leverage to stop or guide them. So that is something that I would like to have. Sometimes it is possible, sometimes it's not, depending on the ticket size, the type of entrepreneur, the business, and the willingness. So I have taken a step back in my recent investments, where I am trying to be active only when I have seen that this level of mindset and this level of maturity is there. Otherwise, I stay away, but of course can help in other ways. So that's my approach.
That's very, very crucial. Let me follow up with pivoting, because this is what exactly you are saying. How difficult is influencing a stubborn founder? Because 99% are very stubborn, but they must be stubborn. You can't be an entrepreneur if I am stubborn myself as well. But at the same time, and I made so many mistakes in my life that I there's no way I can count all of them. But at the same time, a successful founder for me must be someone big-headed, stubborn, but willing to learn from people that made already mistakes. And they succeeded, so they know what they did wrong and right. How complicated is convincing a founder that their road is wrong and 99% will bring to failure and pivot? Because for what I can see, founders perceive pivoting pretty much like failing.
True, I think this is a hard one, and it's usually quite hard to convince, especially if you're trying to put your vision and what you see onto a founder. I think sometimes when you know that a founder has a very strong vision, and they want to get there, you can start with probing with a lot of questions, and very strong questions like, okay, if you do this, where are you going to get? What is the outcome you're coming to? Such questions, very open-ended questions, and not like, how much ARR am I gonna get in next 6 months? When am I gonna get my money back? Those are, I mean, it's a little bit.
We go there. We go there.
Yeah, we tend to go there because we are a bit concerned. Of course, we should be. So if you ask those kind of questions, and you start seeing that they're able to answer those and consider those, and not answer it because they have to give an answer, because entrepreneurs start becoming that. They become answer providers after a while, because everybody is asking them questions,
Yeah, I know,
from
I know.
pitching times to the customer. Everybody's asking questions, so they get good at that. But it's about thinking and being true to that business. Don't build the business for your identity. Don't build the business for your investors' identity or their growth. Build it for the customer, for the market. Sometimes the customers are right, but they're also not right. So you need to be able to find the signal to noise that you see, and that mindset is hard to find. And one way of triggering that from my side is asking the right questions. And if they're able to answer, that's a litmus test. If they start giving you other kinds of answers, then you start seeing that, okay, this person is hard to at least show, like, I'm trying to show you a path, maybe you want to take this. But then if they come up with another way of executing it and then showing the results, then that becomes a path, right? So you could be aiming for a 10x or a 100x, but it's a choice, and it's a choice architecture that you define. And every entrepreneur, believe it or not, is blind. And because they're operating on a lot of assumptions, they are having operational problems. They are
Yeah.
having pressure from investors, customer complaints, and all that, and they're not able to juggle this. And that humility should be there, even if you don't have it in the beginning, in your early stages. You need to start developing that and add the right people who give you the signal. So this is hard to get, and I don't know if I have great examples here, but there are businesses that are running quite well with a lot of support like this. And they add on. What they've done is they've been strategic as they go. They don't become executors. So a good balance of strategy and tactics with an outcome oriented thing. So the outcome should be clear results, but also a little bit exploratory, so that you don't forget to learn as a
Yeah.
founder. The moment you feel like, I know this because I've done this, that's when you lose your humility, and someone has to remind it. And if you don't have anyone, just please create that system for yourself. So this is where the advisory board, the mentors, have a big role to play.
Let me let me move to first round, okay? So, Iman Founder, if I'm coming to you because I'm raising funds
Mhm.
and I am, let's keep pre-seed stage. Uh, what I found, I had to say, upsetting me very much so, is an angel giving 250K, and regardless the how much you give to these guys, right? Regardless, taking 30, 35, 40% of share. So, me personally, if someone comes to me already losing at the pre-seed stage 40%, I would say no, regardless. Regardless. You can be the new Steve Jobs, regardless. So where do you see, regardless, because you already killed the company, 40%, this guy is going to lose majority. The next one, even if they use dual shares, although pre-seed stage, they very rarely they have dual shares because company are very, I mean, you can't create such a complex structure at the very, very beginning. That makes sense. What do you think is the right, regardless how much you are investing, right? Because the investment goes pairing with the value of the company, okay? But what can be a good percentage to take from an early stage founders? 10%, 20, 5?
Yeah, I think this has become a little bit of a market trend. Like, if you look at the traditional way of doing it, you would do it based on what is the value you're bringing, right? So if I'm coming very early on, I see that the founders don't have the money. They're putting their savings, or trying to get some loans and then getting this. It doesn't make sense for me to come in and then say, well, I'm gonna need you to pay me back because I'm giving you some hours. So you would rather put your sweat equity, or like gain the value that way, and then help them grow. That In that sense, I think it's better to take a little bit more because you're adding value early on.
How
But
much more?
how much?
How
Well,
much
it
more?
depends. I would say somewhere around 10% is a good number. If you see any incubator, this is what the numbers are around. So somewhere between 9 to 15 is usually the range. But
10% give the money or 10% only for mentoring, advising, all this kind of stuff?
It depends on the value and the stage. So if it's pre-seed and there's no revenue and all that, then it's better just to have the equity, and then you put in the money according to the sum that you put, right? And then you can build on top of that if you add any other additional hours. But if you have revenue, then I think it's good to keep the balance. So you take some part equity and then part funding that you do. It depends on how much you believe in the business case also. uh, but what has happened, like this is the textbook way of doing it. There's a amazing person, Ashwath Damodaran from, I forget the university where he teaches valuation. He talks about every company having its own life cycle, and that there are two types of people, like storytellers and number crunchers, and these two need to go well together. And he does the valuation of these companies based on a few of these kind of methods that he has found. And when he goes out in the market and then tries to evaluate companies, he gets surprised, because there are companies from a textbook sense, if with the data that he sees, should not fly, but they're flying. The books are read and they're still flying and they're still raising. So it's speculative. When it becomes speculative, what happens is you also become like, okay, I need to run uh, not only based on my effort, but also on the dream that I'm going to get a lot more. So let me buy the speculation before even the value is built. So we are being greedy that way. In general, the economy of things, why it is so, how it is so, it's a very hard question to answer. I think we probably need some sort of an analysis here. But my approach is fairly, as an angel, very simple. If they don't have the money, I'll try to bring the value. I'll probably take an equity of whatever I told you, and then if it is revenue, then I try to divide it. So maybe 5%, and then add the necessary amount depending on my situation also. And if it's much later, like where I'm helping them scale and all that, it's even smaller. And of course the value is big, right? So you need to see what valuation you see, what is the pricing that people can are ready to buy it. Like it could be a product that doesn't really make sense, but people still buy, like these crystals that you find in the market,
Yeah.
like they're just stones, but some people believe they create auras and magic and all that. So there is a huge demand, and sometimes the prices go all the way to $100. Sometimes it's just you get five for $3. So
Yeah.
how do you value it, right? They're all shiny and looking colorful and all that. So my way of doing a litmus test is, are you really solving a problem? How many customers do you have? What pilots do you have? And where is the growth factor? And if I am able to assess that, then I see the value. That's my business case. And then I say, okay, I put in a lot more money and then I take more equity, or I take lesser money and I put some time and then I take lesser equity. But I try to see there is a good balance, that the driver of the company is well fed and then they're able to do this, because they are the main drivers. You're still guiding them. So try not to become that, unless you really want to drive it yourself, and then you do another kind of, like it's another kind of game. It's a bit nasty sometimes if you see, but it happens, and you've seen a lot of such cases out there.
When it comes to valuations, I mean, that's a very hard topic.
Yeah.
Uh, have you ever accepted a founder valuation in your life?
No, not really. I mean, it's always challenged, because it's also a game. It's pretty much poker, to be honest.
It
uh,
is.
an experienced founder who has pitched for a while knows, like, okay, well, if I ask for too low, I don't get the value that I want, and I don't get the runway. So let me bulk it up, and then they make the story around that. This is why I like Ashwath Damodaran's way of thinking, because he balances the story and the numbers, and that's where the answer is, in between those. But if you just buy the story, and let's say you are the lead investor and I believe in you and you're my friend, and you say, Praveen, go for it. I know I put all my money. I'm all in. Still a bet. Still poker,
Oh yeah, of
and
course,
both might lose it,
of
or
course.
we might both might get a 10x. So it becomes a gambling game, and I honestly don't want. Uh, businesses to be a full gamble. I mean, there is a sustainable, systematic way to build businesses and grow them. You don't have to be a 100x company every startup. Depending on the market, depending on the problem you solve, you get your share. Like there are all kinds of birds you can have, but you don't have to aim to become that just because it's fancy. And this is what I meant when I say I don't want to go in for the vanity and the identity. I want to do justice to the business, to the problem, and get that.
I mean, based on my experience, I come from private equity, M&A. I mean, all my life has been there until 2010, and after 2010, 2012, and after I moved to venture capital. And when I moved to venture capital from private equity, it was a bit shocking for me, right? Because venture capital valuations are a bit absurd. There's no cash flows at the very beginning until A, B round. The amount of cash doesn't even cover, if there is any revenue, doesn't even cover the cost. So which means a bidder is absolutely zero. And many times founders raise in a full loss for years to come with the promise one day, I will give you 1 billion valuation, still making loss. So it's very hard, at least for me, to evaluate a startup at the very beginning. And which kind of, how do you assess a value a startup when you have 2-3 founders, maybe build the first startup with no experience? Are you more related to the addressable market? I mean, the obtainable market where this guy actually can sell. Even here, it's always from the top to the bottom, which is a kind of approach I don't like that much. And or to the experience of the founders, if there is any, to the quality of the team. Maybe it's more. It's a team that can in somehow compensate each other, covering the main aspect when you start a startup company. So how do you assess a startup? It's very difficult.
Yeah, I try to look at it from a different four, at least four different perspectives. So the team, I like to see if it's one person, then of course they need a lot of guidance and support. I try to see how resilient they are, how much they are
Do
quick
you
to
invest in
learn.
solo founders?
I have not so far, but I have done due diligence.
I'm a
So
solo founder. I've done 6 startups in my life. It's a nightmare. Uh,
yes,
it's a serious nightmare. You don't sleep at night.
no.
I don't even know why I done. I'm still doing. I did EquityMatch alone, but it's so tough. So I would never invest in solo founder, honestly, unless this person inspired me so much. So wow, this guy can only do good. It's so tough.
No, I agree. I mean, if they're very early on, I mean, I reckon them to get somebody who can, be their co-founder. I also avoid if they want to just keep solo for a long time, beyond validation and such, or when the going gets tough. I also avoid husband, wife, or partner
Oh no, no.
combo. It's too much bias in there. I mean, we need to be human here because even with your best knowledge and intelligence, you have biases. We all have as humans, and here we need to be mirrors to each other and build that complementing skills or thinking. So from a team perspective, I try to see if there is a balance, if they're able to get out of their mind for a while and then change the perspectives, question it, because in the beginning you like your idea, you like the baby so much that you become blind to everything. Everything looks good, and you don't want it to be challenged. So that blindness comes very easily, whether you want it or not. So that's one aspect. Then I see what is the product that is being looked at, and how strong is its leverage or moat to be built. So if it's a deep tech, for example, what is the level of depth you've gone to, and where do you cover it, and how hard is it to be run over? If it's an application, where is the uniqueness, and how quickly can you scale? And if it's biotech, what are the kind of moats that you've built to preserve the uniqueness of the technology, and what are you basing it on? A lot of the times it's research, and research to industry is also another thing. Also, another thing I avoid is if it's a pure researcher entrepreneur, I avoid it because they don't really understand the industry and the execution part. Some have surprised me, but most of them, there's never an end to it. It's the perfectionism loop.
Yeah, no, no.
It keeps going on. So, and then the third part is that I look at the market itself. Just look how conducive it is. It's about being right and in the right timing and the right place. So are you able to reach those places to go to that market, and what is the market asking? Maybe the market just needs a smaller solution and you are over engineering it, and then you have like a big chunk of the solution just because it's cool to build.
Cool.
So, there's a standard phrase in product management that 90% of the users use 10% of the features in a product, and the rest of it is becomes bloat for them, for those
Yeah, no.
90% of the users. But we keep adding because we are like, this chasing the features, feature list, the more and the better. That feeling, it's again vanity to an extent. So I try to keep it very sharp and serving. It should serve the problem and give convenience or value or growth. And of course, I've not had all kinds of startups. But and then the fourth part is the asymmetry. So if I take this bet, do I win a lot if it works, and do I lose less if it doesn't work? So that is something that I'm being very uh, curious and careful on to see what kind of path will it bring. And that's why my bet is on mostly these kind of upcoming. Right now we are in a very good time of a lot of inflection points in the technology domain. So we have AI, we have quantum, we have biotechnology like CRISPR and such. And in general, the whole new generation of Gen Z is coming into the active zone of being the bread earners for a lot of families, and their mindset is a bit different compared to how it has been. And the world economy is changing, the order is changing. So I try to look at that at a larger scheme of things, and then see where are the bets going. So it's super hard, and I probably, even with all of this, still playing gamble and having this poker game, but at least I feel better with those bets because at least I've done the homework, and I'm not going by someone else's rationality, even if they're right. I would like to have that choice to me, and then I would like to give the choice to the founders to drive themselves that way if I'm guiding them closely. So I don't take too much or too little. So it's a little bit of that balance that's needed. But hopefully there are some tools that will come out. I've seen some AI tools that are coming up that are helping due diligence. A lot of the times I've seen it's just investor trends and dynamics, and who is the lead investor, and how much they're betting. If Apple is going in with a
Yeah,
small
of course.
stake, everyone else just follows. It's like that. So you just follow the money that way. So it depends on your investment thesis, how true you are to that.
Where do you see the trends? I mean, where in 2026 the money will be deployed?
I think the trends are going more towards the technology domains. I told you AI is going to bring augmentation. We need to still figure out where is its core usage. I think we have. I mean, the AI will only get better from now on, but we are still using very small percentage of what AI can actually
Yeah.
provide. And AI is a very abstract term, and there are very many pieces to that, right? So if you're building the infrastructure or the consumer level augmentation, or are you doing computation? So I typically say when computation changes, commerce gets enabled, and when commerce gets enabled, convenience changes. So because of this range of changes that's going to happen now, uh, banking will change, and convenience will change. So the type of products that we have seen so far with SaaS and all the internet based ones are going to multiply into another thing, with a lot of augmentation, automation, even. Uh, I'm very curious of how it goes. It partly depends on where our ethics and where our as humans, where we are putting more effort on, and how much access everyone has. Uh, hopefully we build something better with the tool for humanity, so we can start, taking good care of each other, and maybe find more earths to flourish on. But sometimes we also do very stupid things as humans, so we might end up fighting with each other. So it's about enabling that part. So that's one technology. Otherwise, I have the CRISPR technology that I believe in is going to help a lot of human health and longevity parts, at least to minimize the amount of problems that we have had. I think that technology is very sharp, needs to be used very ethically and in good hands. And I believe there are some interesting changes coming. Otherwise, I believe in quantum, again, computation and sensing. Uh, Nature is already the best in that, but if we can augment that to our five senses, it's gonna make us even more stronger. Apart from this, it's a lot more about the lifestyle and helping the aging population. If you see, the world is becoming more and more older.
Oh yeah.
Countries, it's not the same, but a lot of countries is a problem, and that affects economy, affects how we are taking care of each other and everything. So care needs to be taken there. So those service and goods industries, they will get a smaller adoption, and it's still a valid area. We need all these pieces.
But there are a few, I mean, not more than few, that say it's AI, I mean, ChatGPT, Gemini, where we want to name, they will kill the SaaS business model. Is that true for you?
I believe we need a newer business model, mainly because I mean, if you see today, if you go out and like find some tools on AI, they're all trying to follow the SaaS model.
Yeah.
And what are they doing? I mean, some of them are helping you add your calendar without you having to be there, or scanning through your emails. And everyone is asking around $10 to $25, let's say, per month. And how many of these kind of tools will you use? It's too many already. And if you get agents, they're going to do these activities in a bunch, and you probably want to pay for agents because they do more than just one activity. But this is
Yes.
going to multiply over time. So eventually, we will have to innovate that business model. It's not because it is by choice, but it's because it's the creative destruction because of the innovation. So some things have to go. Like we used to have typewriters, and then keyboards came in. So some things have to go and then have to evolve. Some things will probably stay. But in the end, I want to see how can we make it available for a lot of people who are not able to uh, have the privilege like we have, some of us, at least. I mean, I've been lucky enough to be able to talk about this technology, read and understand. A lot of people don't have it. So how do we make their life better? And you can't keep charging them $10 to $20 for a small service like that. So I
Yeah.
believe it's going to come. How the economy changes, how the commerce gets enabled, it's all up to that. So I believe, from a technology point of view, there's large language models that's what we are using with ChatGPT and Gemini and such. A few others talk about large quantitative models, especially in the quantum world. And then there's also world models where spatial intelligence comes into picture. So when you combine these things, you don't know how big it gets. And if you see quantum just in general, so today's world of electronics is based on two states, right? Zero and one. Quantum can give you five. So if you have
Mhm.
come into having a device like this in my hand because of two states, with five, I don't know what we can do. So the applications are very many, and it's up to our imagination and what we get to execution. So I believe it's going to happen. How and what is a bit tricky to know, because we need to evaluate step by step.
Let me go back to founders. Uh, the way how they pitch, I mean, when they come to you a pitch, I believe you see many pitch per week or per month. Uh, there is any way founders should actually pitch to investors, especially when it's an early stage where numbers are very little.
Yeah, there's no strong way. I think the best way is to be able to give your vision and mission, and your honest statement on why you want to do it, and what you're trying to achieve, which problem you're solving. If that message is clear, I think at least early stages, I think the angels will like sort of pick it up. Of course, the ones who are not ready for that kind of unclarity, or unclarity in terms of numbers and valuation, they will stay away. But at least you're able to get your story intact, and then you're still aiming for that direction. But as you grow, you need to start looking into numbers. And I believe even when you don't have the numbers, you should be, as an entrepreneur, be able to model things. You need to look at numbers. It's like calories for the body, right? Even if you're fasting, there is a certain amount of calorie that is burning out. So that's the same case for a company. Even if you're not getting revenue, you're burning money, either in
Okay.
terms of time for yourself in the beginning, but then as you start going out, you will start burning. So you need to be able to know what numbers mean, and when does it become a pain, and when is it a boost. So it's a fuel, right? That's how I see it. So every fundraising aspect is adding fuel to your different stages of your rocket. And as you want to climb higher, you want to add more and burn more fuel. And the need to fly high is passion. And then you need to really struggle a lot early on and build the necessary parts. So you need to design your pitch to be able to showcase that you're able to think that way. Of course, every initial pitch that I see has this hockey stick. If I see the modeling, but that's also something that we laugh at, like, investors, when we know that, okay, yeah, sure, it's a hockey stick, but then we
Always
question,
in this way.
we basically ignore the stage. So and then we start falling back, like, okay, where is it really that this person is telling the values? So I would reckon that it's better that you're honest about it, at least to the angels. As you go to the VCs, I mean, the angels are more responsible for your growth and nurture, while the VCs are more for their conviction and your conviction to pursue on this story, that you're able to fly. That's why they put a lot more. And now the worlds are merging, because VCs are coming in very early on, and then
Yeah.
they're securing this. But I personally believe it's more like the venture studio model. So I can see the pitch evolving for a few months, and so I try to not go in very early unless I really like see, okay, everything's perfect. This person can really sell and can influence the market. Even those can have surprised me sometimes. So it depends on where my personal investment thesis is, and where I want to exit based on the idea. If I want to get out early, I don't see too much of that. But if I want to stay there for longer, I would like to see a few iterations, and mold them a little bit and help them with the analysis. But typically, I would like the balance of story and numbers.
That's another good point, exiting. When founders, as we talk about pre-seed staging, when founders come to an angel, and the angel probably in mind has 2 3 years time frame where actually they would like to exit. Where do you see the exit for an angel investors? I mean, because there is no way this guy would be bought out or any IPO in 3 years time. So the exit for an angel can be only in the secondary market.
Yeah, I think that's a hard game also, and I usually add 30 to 40% more time than what's promised. Like if they say 3 years, it's probably five, and you need to also assess as an investor your risk capacity and how long can you can hold, and how you're diversifying your portfolio, right? Because we don't get the returns on time for any of those, and it's also becomes a time game, your situation and all that. So secondary market is one way to do it, or if you see that the idea and the market is starting to reach the maturity, maybe it's good to sort of get into mergers or of some kind, and start enabling those kind of connections from an angel's perspective. So we need to secure by our own effort what is the next stage when this gets ready. How do I sell my stakes here? Do I sell it back to the founder? Most likely not. In some cases it has happened, but mostly not. But secondaries, or another connection that can be a VC or a bigger investor, and then you say, okay, I'm going to exit here, but this has been my journey, and I give you the confidence on these founders. So it's been a great journey. So you need to secure that part a little bit, or you make sure that the business by itself as a valuation goes up, so you can start doing an early IPO of some sort. Rare cases. It's so much noise out there now.
Oh yeah,
You need to play out these cards, and even with your best strategy, it doesn't play out because of market variance.
yeah. It's very complicated for an angel to exit in a decent time frame, at least for what I can say. Uh, let me move a bit to technicalities.
Mhm.
Should founders raise money with convertible, or they just should go with safe if accepted? At least in Europe, founders, when they can't raise in equity,
Mhm.
and safe node is not something on the table because not all investors understand what a safe can bring, and maybe it's too risky for them. Uh, should they raise in convertible or not? That's that.
It's a little bit of a landmine sometimes. I think is safer, but convertible notes, unless you have the conviction that you are able to turn around the company and start getting the funding from the products from the customers. I would not suggest the founders to go there. Of course, it's a safer bet for the investor, because then I know I will get this money whether this person fails or not. From a founder perspective, it's a bit risky, but you need to make a bet somewhere. Even in both cases, you're making a bet. It's about the conviction of your bet. Here you're more certain, here you're not. When convertible part fails, then you have a bit of a taxing on you. Safe is a little bit more safer, like I said. So it really depends on the type of investors that you meet, and what kind of deal they give you. Sometimes the startups don't have a choice because they just need the money. They say, and then the investor says, "Well, this is what I can give you because this is what you are and how much you're built. I don't see the confidence. I don't believe in the hockey stick or whatever." And then they say, "Okay, well, I need the money, and I'll somehow take it, and I will make sure that I'll give this back." And then they take loans to cover it and all that. On the other hand, you cannot you can see some startups demanding that we only do this, or they go the SPV route with a few other investors helping them. That's becoming more and more common. Also, it's not the best bet for the investor. Again, it becomes a lot of the SPV manager becomes the person in control, and it gets complicated, and
Oh
it's
yeah.
evolving as we speak. So a lot of things are going just into incubators and accelerators, and then they provide that framework to the startups, and then they just go with that path. Once they're out of the acceleration or the incubation, then they start feeling the heat of these things. So there's no one way to do this, I would say.
Many funders they tell me, okay, but we will be able to convert in equity. It's okay, but it's not up to you. It's up to them. But I mean, that's fine. Another thing that, unfortunately, we are very close to the end, but I wanted to cover two things. One technical, and after we have the last topic to cover. Uh, let's move to safe, okay? I'm not sure all funders understand how to structure a safe.
Mm.
Uh, with many funders, when I talk to them, I say, okay, but if you cap and you cap too low, and maybe when you convert the safe in equity, because the next round will come, and maybe the valuation of this round is 10 million and your cap is 5, you get 50% discount. So the
Mm.
amount of shares, the amount of equity you lost, it's very high.
Mm.
Uh, how do you see founders should have someone who really help them to structure a safe note?
I think they should definitely should take help of some sort of uh, expert that they can reach out to, and then try to do a best guess. But I also see from a situational point of view, if I'm a founder now and I know this is my state and I have a runway of, I don't know, 6 months, 8 months, 9 months, and I need this, and this is the best I can have, and this is the conviction, and these are the signals that I see from my current pilots or customers, then you have to at least make sure that you survive for that 1 year. So you end up losing. I mean, you're betting on the equity, and then that's why you sort of go on the lower side. But like I said earlier, some founders are like, inflating it a lot more, so that they say, oh, you're surely gonna get it because we're gonna make it, and then they bring it too much, and then they might get a smaller ticket than they expected. So it's a fine balance, and it's about how how far do you want to extend, and how much effort do you think will actually realize into value. I think it's just again a bet that startups are taking. I don't know if a safe expert would be probably 10-25% better than a founder, but they are also doing some sort of a bet because they assess the company with their knowledge, right? And
Of course.
yeah, yeah,
Let me close with two questions. First of all, why you brought yourself into the venture capital to startups? Because it's very difficult. Investing in startup is extraordinarily complicated and very, very risky. And the second is if you can recommend, if possible, I mean, to funders, uh, which sector outside AI, generally talking, right? Not everyone can build a ChatGPT for the amount of billions they need. Where do you see this market evolving? I mean, the technology, the sector where probably in the next 2-3 years, that's the more or less time zone of any founder starting today, uh, the money and the trend going.
yeah. I'll answer the second one first. So I think the trend is going more and more towards convenience experience on one side, and the other part is going towards better digitalization beyond being internet enabled and secure. So like cybersecurity is security in this case. So bringing that part into larger organizations. So any solution that are doing that. Goods and services industry is also getting a lot digitized, so they need to build this moat also. So that's very immediate conveniences, like I said, and it depends on which country you are in. Other than that, I my usual sector is deep tech because that's where I know more. Otherwise, I try to look into something that's a bit more technology enabling human health or human well-being, and like basically making part of my daily life or our daily life a bit better with the augmentation of technology. And typically, deep tech has that. And you don't have to, for deep tech, you don't have to build the whole infrastructure. You can just look at where the gap is and then just take that. And there are a lot of papers, a lot of patents that you can give royalty to and then start building on top of it. It's about finding that niche and then being able to solve that. Education is one interesting sector. Is gonna also change, not just because of AI, but because the access to knowledge is cheap. Everyone has a device, and information is out there, but guidance is missing. So making it a bit better and making it specific to a type of learner. I mean, I'm a visual learner. and some other people are like, they're learning based on their listening abilities or kinetic abilities. So how can we tailor it to that person so that they can, make better use of their intelligence, and you can bring even more smarter people out into the world, and then give access to a lot of people who don't have education. So I think these are the immediate trends that I see. Otherwise, it's mostly the ones that I told you earlier on.
Why you became
Oh,
an investor?
got that one. Yes. So it was by chance actually. So I just ended up meeting a few people that were building a syndicate at one point of time, and I happened to know them. I was networking a lot at that time, and they said, "Would you want to join?" And I was a technology person. I had some savings, so I just went in. I was blind, to be honest, but once I went in, I started realizing. I mean, they were much older than me. They gave me a lot of know-how, and they had some uh, business visibility, at least for the thesis that we made. And through that, I started looking into a lot more startups, and I had built a few things before, but it changed my way of looking into, oh, this is the other side of things. How are investors looking into it? Until then, I was a blind entrepreneur, let's say. So that helped me a lot. And once I started doing it, it became a little bit like a sustainable way um, to help people. Like I don't believe in necessarily charity. Of course, knowledge is free, but you cannot help everyone, handhold everyone, right? So
Yeah.
when you augment them with a solution, then you help a lot of people at once. So sustainable way of building. Secondly, it helps me with two levels of compounding. One is compounding of my knowledge. Just because I read a lot of pitch decks and ideas, I start to see, oh, how smart people are looking at a problem in multiple ways. And then I get to know about, I've learned about textile industry, I learned about motorboats, and manufacturing, metal manufacturing, and sometimes like simple businesses like clothing, like a small retail shop, all kinds of startups. And the other ones have been like deep tech and such. They have some domain knowledge, so it helps me expand my knowledge. So my knowledge compounds, and if my investments go well, my money compounds. So it's a asymmetrical compounding on both sides. Even if I just look at the pitch deck, even if I don't invest, my knowledge increases. So that's why I'm in this, and it's a way to nurture with whatever skills I have. So what I've done is started a small program called Startup Magic, where I take like up to 10 startups per year, and then I try to help them to grow to their next stage wherever they are, somewhere from pre-seed all the way to Series A. And I try to be much closer, like relation and then guidance, all the things pretty much what I discussed today in this 1 hour. I try to bring that into action, but in a very actionable, lean format, so we don't spend too much time. And I hope it brings some sense of giving back while I also learn, and that's why I'm here.
Praveen, thank you so much for coming to the Investor Talk. It's been an absolute pleasure for me. Thank you.
Pleasure here as well, and I'm super happy to have had this chance to firstly meet you, and of course answer questions. And I hope this discussion of ours helps lighten up a few other minds, and then more things come out of that.
I'm pretty sure. Thank you.
Thank